Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Welcome, everyone, to our normal Thursday Zoom call. Today we've got Snipp Interactive, and I believe it's the CFO, Richard Pistilli. Snipp Interactive trades on the venture exchange under the symbol SPN. The stock closed at 9.5 cents and has 286 million shares outstanding, roughly a $27 million market cap. It is December 18th, 2024. Richard, how are you doing today?
I'm doing quite well. Thank you for giving me the audience this afternoon.
Excellent, excellent. Well, listen, we've had the opportunity to listen to presentation in the past on Snipp. So really, what we're looking for is more of an update. But for those that are not familiar with Snipp, maybe give us a little bit of a business summary, and then we can get into some updates and some follow-on questions.
Absolutely. Just by way of introduction, I am the CFO of Snipp Interactive, Richard Pistilli. I come from over 15 years of investment banking experience on Wall Street before developing companies. Developed the company and sold it to Snipp Interactive in 2022, integrated into the business, and then assumed the role of CFO effective 2 months ago. Snipp Interactive is a marketing technology company. We work with some of the largest Fortune 500 companies around the globe because we help them solve one of their biggest initial needs, which is engagement, retention, loyalty, and data collection on their customers. And that's essentially what the company is. It's a technology platform-based business. It's a service provider. The company's been in existence for about approximately 15 years. The company has grown to the point now where we work with over 250 different clients around the globe, 100 employees around the globe in 5 different countries. We generate revenues from providing technology-based promotions, sweepstakes, rebates, rewards, incentives, as well as full-blown loyalty enterprise level solutions and licensed software developed deployments. That's what the company does. In the past several years, the company has grown. It has had some headwinds along the way, as much as any other company has. However, ours are quite specific. With the integration of the Gambit loyalty business, which is what my company was acquired by Snipp in 2022. Snipp was required to assume responsibility for a single legacy contract from that business. That legacy contract was a very high revenue generator, but very, very low margin producing contract, which is obviously how the prior business was operating. That was serviced, performed, and exited. We attempted to renegotiate it. The economic terms were not going to be fitting to our model, so we exited it. That business concluded in December of 2023. However, that contribution to the combined business had the impact of showing high revenue growth, declining margins, followed by, in 2024, steadily declining revenue, albeit at tremendously increasing margins as the business gets back to normal. When we strip out that core component of the business, that one contract, what you find is over the last 3 years, the business has been growing at a 28% core revenue growth rate on a compounded annual growth rate basis. We have record backlog into our pipeline of future contracts and unrecognized revenue. We are EBITDA positive. We have been, as always, debt-free and self-cash flow funded. Our solutions are based on technology that are out of the box, but are based on over $40 million of investment in developing our proprietary solutions. That $40 million is of capital does not show up on our balance sheet as an asset because from an accounting standpoint, 95% of what we develop is expensed as incurred. So if a client wants to commercial us to access one of our technologies and then like us to develop an additional enhancement, that will be done, but it will be recognized and billed and expensed to the client as is. As a result, we now have over $40 million US dollar technology base that is the core value of all of our economic creation, all of our revenue, all of our contracts, all of our services. That's called future economic deployment. That does not show up on the balance sheet. So there's a miss in that component. As I mentioned, we work for Fortune 500 across the globe. We have a company that's actually built properly with a senior management team with over 20 years of expertise in each of our fields, from legal to operations to sales to finance to the executive position. We're a quite deep benched sort of company. And we're at a position now where the market is now starting to recognize that our price value is dislocated. Part of the reason of that price dislocation is the Gambit revenue contribution or distortion that I mentioned. But the other component is the fact that in 2023, we moved on to a new auditor to handle our public reporting. That auditor's process was a long delayed process, primarily because of the Gambit revenue recognition and expense accounting treatment. We exceeded the statutory requirements for delivering financials. As such, we were suspended from trading on the TSX.V for a period of close to 6 months. At the end of that period, the auditor ultimately concluded and finished their analysis and diligence and deep dive and concluded that the company has a clean bill of health. There was never any misconstruct with the accounting or reporting. There were no major restatements or recertifications done. And we were given the green light to move forward, conducting the business exactly as we had been doing it. However, after 6 months of trading halt, the stock obviously took an impact. And so now the stock is at a depressed level. And we have lost confidence in some of those investors who do not understand why that occurred, seeking liquidity and seeking confidence. As a result, we've executed a plan over the last several months to actually demonstrate to the market, no, all the company's done is integrated an acquisition, invested in its core people and expanded upon its assets, completed our technology suite. We do not have any major capital expenditures in the pipeline. And now we're actually at a point of turning those operations and investment into earnings, cash flow generation. Q3 was released about several weeks ago. We reported record quarterly EBITDA results and top line growth of over 20% on the core business. We anticipate for the close of the year, we will do the same thing. And for the net year, including the Gambit component, we will still be EBITDA positive and reporting growth, albeit not at the revenue line because of that contract. And going forward, we anticipate that as we look at our pipeline and as our investments are now actually delivering operating leverage, an incremental profitability, margin contribution, and earnings towards our shareholders.
Perfect. Thanks so much. For those listening, remember, if you've got questions you'd like me to ask Richard, feel free to use the chat function. We'll do that. Richard, you mentioned debt-free. I didn't hear if you mentioned your cash balance. I think as I saw last, about $4.6 million in cash.
Correct.
What do you do with the cash?
Currently, cash is operated as course, they hold to support working capital to be
Mhm.
reinvested in the business. We're coming out of a period of growth or investment development where all operating cash goes into the business and expanding our people and our technologies. That's now, from our perspective, completed. We're in a sufficient position to now start harvesting on those investments. So that cash is now going to start matriculating and give us the opportunity to do additional decision making with it, whether that be strategic alternatives, whether that be addressing the shareholder registry, whether that be addressing where else capital needs to be distributed. It doesn't go to sit there, it goes there for the most optimal, efficient use as capital has to be.
Gotcha. And as far as any new initiatives, I see one of the most recent press releases is the partnership. How do you grow the business from here outside of just sort of your typical organic growth?
Yeah. So the core business, and a lot of people talk about organic growth. You can look at our client list and who we work with, which is quite remarkable, and that sometimes gets overlooked because the model is we do deliver products to customers, whether that be simple campaigns or programs or low margin sweepstakes. We do it with the initiative of building relationships and getting to enterprise level sales. We can then deploy the rest of our product suite. That actually has been demonstrated. We took a look over the last 4 years. Our top 10 global Fortune 500 companies have an annual average revenue CAGR with us of 72%. So yes, when we work with companies, it's not a one-off, it's a starting point, and then we grow. So our opportunity to expand our share of wallet with our existing client base is tremendous, expanding it both geographically and also product-wise, as well as moving into new verticals. So we see tremendous opportunity in the core business of what we're doing today. In addition to which, our final investment in completing our product suite was Snipp Media, which was launched earlier this year. Snipp Media is essentially the last leg of the stool, where as a marketing technology company, we now have an ad tech component. We're now building our own audience. We have our own media of eyeballs and users that we can monetize and deploy to all of our customers. That is primarily based on financial institutions and banking partners. We launched it with Bank of America. We then launched with P&G, and we have a pipeline of additional partners coming in 2025. What that does is it allows us to use Snipp Media to service financial institutions and their reward programs with card-linked offers. Those card-linked offers are essentially being delivered from our client base. So we are able to actually harvest our client base and provide volume and inventory for card-linked offers, all of which is underpinned by the Snipp Check technology, which is receipt capture data. So if a member of Bank of America Rewards wants to redeem a rebate or cashback on a consumer product such as Starbucks or Pepsi or others, they will do that by actually purchasing the product and uploading a copy or taking a picture of their receipt. Why do we do that? Because that's the core underlying that everybody wants. They want that receipt technology so they can see what are the consumers' behaviors, what do they purchase, what else do they purchase, when do they purchase, and what's their sensitivity? Is it price focused? Is it time focused? Is it location focused? And that's what our AI engines actually package and deliver to both sides of the equation, which is why the banking institutions are working with us. Our early results with Bank of America have been tremendous. Our user engagements, our redemption volumes are higher than we anticipated. We're enhancing and increasing our amount of reach in their audience, which obviously is ultimately very, very scalable, while also now taking that data and deploying it to assign new clients in that space. First example, as I mentioned, was P&G. But that is a leg of growth in the business as we think about it going to 2025. We see that as the assets there, the investments made, we have the right people running it. There is no additional significant capital expenditure or investment needs to be done to scale it. It's operational and ready to go. Similar to Gambit, Gambit is now integrated. It will be relaunched as Snipp Sports under its Snipp Win category. It's integrated. All costs are gone. We're ready to leverage. However, we do not look at 2025 leaning on Snipp Media. Our view is we do not report numbers to the market until they start materializing in a way that we feel confident that that's where we want to signal investors. So that is still a small revenue component. It's possible it may be a larger revenue contributor in 2025. That is not our planning, our budgeting, our modeling, or our expectation. We look at 2025 as another year of 20 to 30% top line growth and significant EBITDA earnings potential.
Fantastic. Now, I noticed in the last quarter, you managed to get up to 62% gross margins. Do you see that? Is that a new level that we can expect, or is it where's it going to fluctuate up or down?
We
with
have
that
been
growth?
historically higher than that.
Okay.
And again, when you strip out the Gambit contract, we have been higher than that. And the reason is it's a consequence of two components. One is obviously increasing operational efficiency over time of executing contracts, but the other is essentially the mix between our low margin, high margin revenue. So high margin is software licensing, right? Loyalty, long-term, multi-year, perennial contract deployments that are essentially exceptionally high margin. Singular RFQs for promotions or a Valentine's Day campaign are low margin. That's the mix of the business. Over the years, the business has shifted from primarily low margin to now predominantly high margin, which is why you're seeing that gross margin move back to where it's supposed to be. Our expectation is that 62%, it will continue to increase to a targeted 65% level, which we believe is sustainable. That is reflective of the mix of business, the operations, and the assets supporting that delivery.
Gotcha. Yeah, that's fantastic. And then you mentioned bookings and backlog. Maybe let's talk a little bit about that. How can you describe what that looks like and any trends associated with that?
Our bookings backlog is essentially signed contracts for revenue that have yet to be recognized, right? That's essentially how we look at that. And that has grown. It's now at historically high levels. I apologize. I forget the exact figure we put out at Q3. It's around the $15 million level.
15.5 million.
Yeah, 15. I apologize. I didn't want to say a number that was incorrect. And what that does is it allows us to look at 2025 and understand this is our core base for where we see business coming. It doesn't mean we're not getting more business. It doesn't mean we don't have additional growth or opportunities. It's that it's already our visibility into how we see the pipeline. So when we think about that 15.5, we look at 2025, we say, okay, of that 15.5, we know exactly what it is, high margin, low margin, what the contract terms are. We know exactly how much is going to be recognized in 2025 versus 3-year contracts that might be going longer. We also know exactly how much existing historical business we have from 3-year contracts that are going to play out in 2025. So we can look at that and give us a very, very highly confident level as to what the base level of revenue generation will look like for this year had we done nothing else going forward. That's where we start. We look at that component, and it is, again, a lot of it comes out in the wash, but you're looking at 15.5 walking into the year with additional opportunities and investments that need to be scaled and are now starting to return new contracts and growth. So that's essentially, you're starting a year off with a high percentage of expected total revenue generation that's already committed. That's how we think about it.
And is it typical that gets recognized within a year, or how quickly does it get recognized?
Most of it gets recognized in the year. but there are components that may be multi-year, and so then that gets allocated over multi-years. But that noise ultimately washes both ways, and the reality is that that number, that quantum, is majority in the year.
Gotcha. So I mean, it sounds like there's been significant progress here over the last, certainly this quarter here, and now that sort of that lower margin revenue is being flushed out of the business. What, from here on in, where do you see the challenges with the business? What sort of keeps you up at night?
From a business standpoint, I think ultimately what we've incurred, as many have, is essentially macro challenges. If the market is soft, if marketing dollars are soft, that's always going to be a concern that we deal with, because we are essentially a B2B to C service provider, and we know that that can change relationships very quickly. Where you can work with a customer for several years, but then their company is now imperiled by a market environment that's declined, and spends are then cut, or budgets are cut. We endure that. We do endure that. We've seen that through this trend. Going forward, I think what keeps me up is recognizing that I believe we have the right level of human capital, operating capital, and technology deployed, and incentive in place to grow revenue with and develop our customers. My biggest concern is execution risk, because I do believe that it's not a question of what else do you need. It's a question of you're in that position, you're delivering on it. Can you continue executing on that, or is there going to be an issue with that model and the execution of it, and changes that have to be incurred? So I look at that operationally. I think that's exactly where I focus.
Gotcha. Perfect. Listen, a number of questions have come in. Why don't we jump on some of the questions from the listeners
Go
here?
for it.
Okay, so Rahil asks, you touched on this a little bit, but says, are you able to share color on how Snipp Financial Media is progressing? When is it going to start contributing significantly to top and bottom line?
As I mentioned, the media is progressing. It has launched. We have signed. We've announced new customers. We have a pipeline for more for 2025. From a financial standpoint, when it will be contributing significantly, our expectation is that it is quite possible it does significantly contribute in 2025. However, our view is, until we actually see, even on a quarterly basis, a threshold of meaningful, sustainable contribution, we're not going to guide the market that way. So once we are, then we will give you the projections as to where that's going to build. The way to think about that, the business is now an option. It's a costless option, essentially. It's built. It's not costing additional investment. It's building new eyeballs and revenues and contract opportunities. And now we will report when that comes to fruition. As we are not there just yet, we do have high metrics with respect to engagement, monthly active users, redemption rates and conversions, and pipelines of now our other clients, primarily CPGs, who would like to participate. So, long way of saying, it's not a financial contributor. It's not a financial cost. We see it as potential in 2025 as being one, but we will not guide the market that way until we have some demonstrable proof of that evidence.
Gotcha. Okay, next question is probably going to be difficult for you to answer, but let me phrase it a different way. First of all, okay, he asks, when are we going to hear announcements on other U.S. banks adopting Snipp Financial Media? Maybe rather than, when, can we expect other U.S. banks to adopt the
You can expect additional financial institutions and press releases adopting Snipp Media. I cannot give you names or dates it'll be dropped. That's just not something I'm able to provide.
Of course, yeah, perfect. And then Rahil also asks, would you be sharing preliminary Q4 fiscal 24 guidance similar you did in Q3?
We are now ending Q4 2024. As soon as we have closed our, and again, it's a little bit more difficult because now you're also starting the annual audit process.
Mm-hmm.
But as soon as we have comfort on closings, we will provide guidance. That would be the anticipation.
Mm-hmm. Okay.
I cannot
Awesome.
give you a date on that because look, I'd love to
Don't,
do
don't
it.
have it.
I'd love to share it with you tomorrow, but you got to go through the process. Can't do that.
Yeah, no, fair enough. Next question from Rahil is Paradigm Capital has 2025 revenue guidance of 25 million USD and 2.2 million adjusted EBITDA. Are you comfortable with the forecast or you think it is on the low end?
My view is that that is a forecast that is certainly attainable.
Mhm.
That is absolutely within our targets and our planning. And do I think that we are working or anticipating towards a higher performance number? Of course we are. Of course we
Mhm.
are.
Mhm.
Um, so yeah, I have to be careful with what I
Mhm.
say on that.
Yeah, of course.
I have to
Yeah.
be careful what I
Yeah.
say.
Yeah. But you're comfortable with the numbers. Okay, that's good. Okay, Jesus says, what are the main drivers for growth or catalysts you see in the short, mid, and long term?
In the short term, it's continued growth of our existing client base and expanding to new clients in other verticals. We now have a sales team that's complete. We brought in our Chief Revenue Officer, Chris Kuba, a year ago. He's been tremendous for the company. He's actually helped us really accelerate our strategies and formalizing our plans for growth. We've revised how that model and incentive model works, and it's already delivering dividends. We think that's actually going to be quite impactful going forward. In addition to which, the Snipp Media component, I can run through the Snipp Media business. We see that as an asset that will be of value. We're already seeing it being demonstrated, but that will be a component of what I would call not the short-term growth, probably the medium-term growth. We also look at the business and recognize that we're at a crossroads where as a small business where the currency, our public currency has been depreciated, that actually limits our ability to do a lot of things. And as we execute and correct that situation while also increasing our EBITDA, we cross into a different threshold where now we have financing alternatives. We have the ability to access markets based on cash flow sustainability that allow us to pursue opportunities that we want to pursue because we live in a market where there are a lot of fragmented competing service providers that have pockets of audiences or client relationships that have tremendous fixed overhead cost structures. And we see the market as an opportunity to say, if we have a currency to do this, we can actually acquire a lot of these components, integrate, eliminate all of their fixed costs, put them on our structure, and generate the return that way. So we do see an M&A growth opportunity. We see a core business continued growth opportunity, and we do see for shareholders a realization that the investments we have made are are in position to now harvest and triculate earnings and profitability to the bottom line.
Mm-hmm. Richard, this question, I'm not sure the answer here, but you didn't write off Gambit.
Because we haven't dissolved the division.
Okay, right.
Gambit initially as acquired was an independent enterprise solution. It can operate that way, but that's not what it was acquired for. It was acquired to be integrated into the Snipp technology suite as a alternative for Snipp Win. Snipp Win is, well, we run promotions. You want to have a sweepstakes, spin the wheel, scratch a card. Now we have a sports catalog. That was the driver of it. The business has not been written off because it hasn't been deteriorated. That
Mhm.
technology is still there. It's moved over. It worked through clients' relationships and delivered what it was supposed to deliver. And any ancestral overhead costs or legacies have been eliminated. So no, there's not an impairment that's there because we look at that as a exceptionally high future revenue potential.
Awesome. Next question is about SG&A. It says SG&A has been growing very fast lately. Do you have any plans to reduce it, or should we expect the same growth in this expense in the next few years?
Now, what you should think about when you look at our financials is we have essentially two major lines of cost. Our campaign costs, which is what drives our gross margin, and our payroll. That is ultimately 80-90% of our cost structure. Right? That's essentially what drives it. Both those numbers have been optimized and brought down. Our payroll has now, I think, is at a level where we've eliminated several costly components, I'll say. We've planned for additional ads where we need them across the organization. And we look at our planning and think about the growth of the business and anticipate that that payroll will be stabilized, will not be increasing in pro rata with revenue growth, but will actually be now at a more stabilized basis, which means you have margin contribution. That's our anticipation there. Our marketing budgets will go up if we and when we find good ROI for doing that. Of course, that's where we want to contribute capital. But in terms of the overhead of the business, management, legal operations, no, there's nothing that's going to be anticipated to be increasing.
Yeah, fair enough. Perfect. Okay, Jeremy asks, can you explain the recent press release regarding unet? You did a partnership with unet, I believe.
Well, we always look to work with technology partners that can actually help us prepare to scale and optimize our internal operations, right? And I don't think I think that's more a point of when you're a small business and you start off doing everything internally and you develop stuff and you take stuff off the shelf and then you develop your own and you build efficiencies. Then you start building relationships, technologies where you can say, wait a minute, there's just a more cost efficient way. We can move in a direction where it's actually going to be streamlined. It's going to allow us to cut waste and time. It's going to allow us to deliver that investment to the shareholder. That's what unet is.
Gotcha. And then follow-up question in regard to Walmart. Please discuss a recent entry into Walmart Media Network and the opportunity this provides. I understand that Snipp was able to reduce fraud and waste compared to the legacy vendor.
I apologize. I'm not exactly sure about what this comment is referring to with Walmart Media.
Okay.
I
Well,
apologize.
Jeremy,
I apologize. I have to be careful what I say. I'd have to look a little bit closer to understand what you mean by Walmart Media.
Awesome. Okay, fair enough. Okay, well, then he follows up with a different question. In regards to Snipp Media, what will be the opportunity to monetize the users? What value could you place on each active monthly user moving forward?
So the value of the users is when we build a base with our financial institutions, we now have a collective audience. As I mentioned, we give them the car lead golfers and we do the data collection. And then we are able to then provide that to our client base for offer walls. That's something that, it's a user-based media model, where as you build that base, now you have an asset value that you can continually monetize, which is what we're doing. In terms of our monthly user value, I can tell you that when we look at our public comparables, companies such as Cardtronics or others, Cardlytics and others, our metrics are right in line with theirs, if not better. So our revenue per user, per MAU, per engagement, we track that and we see our metrics lining up in line, if not better. That's the best way I can say it.
Gotcha. Now,
and in terms of active, I apologize. I'll take this question a step further. In terms of active monthly user value, once you establish a owned media user base, that means you have an asset that's valued differently in the market. It's based on a multiple of obviously dollars to eyeballs. Close competitor of ours or company that's similar to ours, Ibotta, that company has about 30 million in their audience, and that gets capitalized between $30 to $40 an eyeball. So it's one way to think about it.
Perfect. Perfect. And then lastly, Rahil says, could you expand on today's press release? Snipp Interactive recognized in Forbes 2025 customer experience predictions. What can you tell us there?
Yeah, I think what that shows you is that even for a small company as we are, our reputation and our people, our thought leaders, our customers are respected, and we are invited to do and participate in these sorts of opportunities. It doesn't make it's not normal that in a Forbes customer experience prediction, when you take industry expert insights from multi-billion-dollar market leaders, that you include a company like us. That's what's unique. So you'll have a multi-billion-dollar global media, conglomerate giving advice on trends and whatnot, and then you have Snipp Media. And that's why I think what that demonstrates is that aside from the financials or the stock or everything else, it demonstrates that when it comes to the marketplace and our solutions, we are beyond respected. We are requested for insight.
Mm-hmm. Yeah, very impressive. No, that's a neat little milestone here. Speaking of milestones, maybe looking forward, investors as we are, we're watching your business. What do you think is the key either catalyst or metrics that we should pay the most attention to?
Like any other business, I can give you a plan or execution model. Watch the it's a show me story. Watch the revenue, watch the gross margins, watch that payroll, and let's see if we actually generate the EBITDA cash flow. And if Snipp Media starts generating, then you're going to see it too. And if Gambit Sports, Snipp Sports, which nobody talks about, starts contributing, you're going to see that too.
Fair enough. And then, we covered a lot of stuff, but what did we miss, if anything? And if we didn't miss anything, maybe this is an opportunity to give a key message or make sure that our viewers are hearing what you wanted to hear.
For me, the key message is I've been with this company for 3 years. I sold my business to it. I have a long history outside of this company, obviously in Wall Street and elsewhere. The integration was done and my contract was done. I had served what I needed to do. I decided to stay to take on the role of CFO because I see a business with tremendous opportunity, with assets that are ready to be harvested, that's being completely undervalued by the market. That's how I view it, and that's why I made my decision to commit to it and take that risk. I think that the public market needs to understand that the people in charge of this company are in control. There are changes have been made over the years, and that's part of development, but we actually have an efficient team and efficient model, and we're looking forward to delivering on what we see as our growth potential. We're very careful with what we say about that because we don't believe there's value in putting out, high target points that you're not going to deliver on. We believe more in developing and then showing, but we'll figure that one out. So I guess my point is I'm confident in the company. It's why I'm here. I do not think a stock that has over $40 million in technology assets, over $30 million of NOL values, over 100 employees in 5 countries, over 250 customers, dozens of Fortune 500s on multi-year contracts, that asset value makes sense at $20 million. I just don't.
That's a perfect way to sum it up. No, I think that was great. We've been speaking with Richard Pistilli, CFO of Snipp Interactive. symbol again, SPN on the Venture Exchange. Richard, this was a pleasure. I appreciate the time you spent with us and certainly helps us in getting update on the business. Thank you so much.
My pleasure. Thank you, Paul. Thank you, everyone.
You bet. Bye for now.
Bye for now.